Another look at our big story. Shares of Snap plunging after hours, down 27% on an earnings miss. It's currently on pace for the second biggest drop since going public. We'll get more on the move with Gene Munster later in the hour. But Snap is not the only mover today. Sam Adams maker Boston Beer, that stock dropping more than 8%. Demand for hard seltzer continuing to decline. Not at my house. Mattel down despite an earnings miss after raising concerns over margins, and Seagate down after missing earnings and issuing disappointing outlook. Intuitive Surgical, that's also plunging. But one bright spot, Tenet Healthcare, that's up despite an earnings miss. We'll get to that in a second. But Karen, earlier in the show, you mentioned sort of quickly that you put in a short for pins for Pinterest. Why that after Snap specifically?
It was down. It's down way less than Snap, which is not surprising. It shouldn't be down a whole lot. I just think tomorrow it's just they're all going to trade really poorly, and I think that. I don't know what Evan Spiegel's going to say. I really want to hear the call because he gives some interesting color and some context. I don't think it's going to sound particularly great. This is a very just short-term trade for me because remember, Elliott is there. Yeah. I don't know how aggressive they're going to be, but I mean, would be an opportunity for them to buy stock. They had the chance May 20th or May the day after. I don't know if that's
when they issued that warning, right?
But I will want to hear the call.
Okay. And Guy, what about Tenet Healthcare moving higher? What do you make of that move?
Full year guide. I mean, yeah, the quarter was ish, you can say, but the stock has gone from 90 down to 54. It's bounced. People say, well, wait a second, the quarter wasn't great. Then they say full year guidance is good. Even at the low end of guidance, $5.80, you're talking about a stock that prior to this move is trading at 10 times that number, which is too cheap in this space. The hospitals are interesting to me. Everybody loved Tenet Healthcare 4 or 5 months ago. Obviously, the market sold off, but I think the stock is really interesting here despite this move higher in the aftermarket.
Well, now we're going to move on to a key decision overseas. Europe's central bank hiking interest rates for the first time in 11 years. The ECB lifting rates by 0.5 point. The market was looking for a 1/4 point, so a more aggressive move. And that aggressive move coming about a week before the Federal Reserve makes its decision on rates. Our next guest warns Wall Street is underestimating U.S. policymakers. Mike Schumacher is head of macro strategy at Wells Fargo Securities. So, Mike, why, when the ECB makes this move after 11 years, does this portend something more aggressive for our Federal Reserve when we've been making moves? They've been taking aggressive stances.
Yeah, it's really interesting. It shows the inflation fight is global. ECB has not moved in a decade. Today it did, finally. Maybe too late, but nonetheless, it did something. And that really shows central bankers are in a very aggressive inflation fighting stance. We think the Fed's going to reiterate that. Yes, it probably goes 75 basis points next week. That's not the big news, though. The news will be when Chairman Powell, in his press conference, at least in my opinion, says, hey, look, this fight's going to go on a while. It's probably going to extend at least through this year, maybe into next year. So buckle up. The market's pricing too little out of the Fed.
So you think it's less about the rate move itself, which you're calling for 75 basis points, and more about what Chairman Powell says about what's to come, and you believe that message is changing? Why? Just because of the ECB?
Not necessarily because of the ECB. The ECB is really just the latest piece to fall into line. So Bank of Canada went 100 basis points last week. US CPI was terrible. So you've had a number of data points come out recently that would, I think, confirm the Fed's view that, hey, inflation's not going to go down easily. Again, it's global. We have to fight back. So the chair's got a challenge, though, because the Fed has lost a bit of credibility with respect to guidance. And I think that's going to induce him to pound the table even harder than he would have done otherwise.
Michael, it's Tim. When we think about the ECB and the conundrum that they're in when faced with record inflation, gas dynamics, political discord across the European Union, and sovereign debt, not necessarily crisis time, but what's your call on the euro as we impute this back into multinationals? Because this is, we'll take care of that side. I'm just kind of curious how you feel the currency continues to move. Dollar's given something back over the last couple of days, but hard to see the fundamentals realigning in favor of being long the euro.
That's right. We're still dollar bulls. Yeah, sure. The euro's gained a few cents recently, as you say, but we think the euro trends down over the next, call it 3 to 4 months. You've got a huge gap in interest rates. It makes it really tough to be long euro versus USD. And also the relative economic dynamics, I think, point strongly to the US dollars. We like the dollar versus the euro. We can see euro going to 95 cents, perhaps lower.
Michael, how long do you think it takes these Fed actions to actually really take a bite out of inflation?
Yeah, it's a great question. And when you think about it, whether it's Fed leaders or leaders of other central banks, they always talk about the lags in monetary policy. But they invariably point out that we're not entirely sure what they are. They're variable. So I would say at a minimum 6 months. And if you think about the first Fed hike being in March, that would tell us September really is the first impact plausibly on the, quote, real economy. But I think really what the Fed's trying to do is tighten financial conditions. And translated for viewers and for all of us, really what that means plainly is equities take a hit, interest rates go up, credit spreads widen, mortgage rates rise. All these things have been happening. So that's the big impact the Fed's been able to get done already. But as far as impacting more core economic activity, we probably have to wait a few more months.
Ironic, of course, after they helped to juice up those markets to get to these levels that they're now trying to cool off. Michael, thank you very much for being here with your take. Steve Grasso, what do you make of all this and what Mike has to say about the ECB potential ripple effect and what it means here for us and our monetary policy?
Yeah, I think that, being Tim had asked him about the euro, and he said that he was still a dollar bull, which means that I believe, I shouldn't say what he means by it. What I interpret that to mean is that the Fed will probably be more aggressive than people think they will be. So that means a higher U.S. dollar, which means it's probably worse for equities, as Mike just stated.
Karen, what do you do when you're this many days ahead of a Fed decision as far as your portfolio, when you've got so many other big factors between now and then when the corporate earnings reports and commentary come out?
It doesn't change anything because we talk about a lot, some days if you gave me exactly what they were going to say, I wouldn't know how the market would react, right?
Okay.
We've seen, giant moves, and then the next day, market's like, never mind, we got that wrong. We're reversing all of that. So it's too complicated to try to game that, so I just kind of ignore.
Which is why everybody has to watch Fast Money every day.
And also, doesn't the Fed tell us more than we need to know? I mean, I'm kind of teeing you up because I think you've got some strong opinions on other.
You're just going. I woke up in such a good mood. I'm like Damone, and you're gonna bring me down. I'm not gonna go down the primrose path. I'm not gonna take the bait. I will say this though. People were saying, peak inflation. I heard Steve say that 9.1 print. That might have been the highest we'll see for years to come. Crude and commodities have come down 30% since basically the numbers for that reading came in. If you take 30% off 9.1%, you're still talking about a CPI with a 6 handle, which is three times the amount that the Fed wants for inflation. So they're about 3 years behind the curve. So he was spot on in terms of his assessment with the Fed. People don't realize how steadfast they have to be to fight the exact animal now that they wanted for years and years, to your earlier point. Thank you, Tim, for teeing me up.
As expected.